Welcome back to the Group Insurance Daily Pulse, your rapid-fire update on the critical developments shaping our industry. I'm Dorian, the Distribution Expert, here to unpack the opportunities. And I'm Aria, the Actuary, here to dissect the risks and the P&L implications. We've got a dense 15 minutes ahead, so let's jump straight in. Anticipated being the operative word, Dorian. My primary concern is the integration risk. Beam's cloud-native AI stack into Principal's established, likely more heterogeneous infrastructure.
Aria, the strategic rationale here is precisely to leverage Beam's agility.
The cloud-native architecture facilitates faster product deployment and iteration, which directly translates to improved customer experience and market responsiveness. Principal isn't just buying premiums, they're buying future-proof technology. Their deep capital resources provide the perfect environment to scale Beam's proven AI models for underwriting and claims, driving down administrative costs and improving profitability margins in the long run. The SMB market is hungry for streamlined, integrated benefits administration, and this positions Principal to be a dominant player, capturing significant market share and enhancing broker value propositions. The ROI isn't just in premium growth. It's in the operational leverage and competitive differentiation. Operational leverage is critical, but so is the P&L impact of the acquisition cost itself. What's the earnout structure? How are key Beam personnel being incentivized to stay and ensure successful integration? And how do we validate the scalability of Beam's AI beyond its current scope, ensuring its predictive models remain robust and unbiased when applied to a larger, potentially more diverse risk pool under Principal's umbrella? Regulatory compliance, particularly around data privacy and security for 25,000 businesses, becomes exponentially more complex post-merger. We need clear frameworks for data governance and robust risk management protocols to avoid potential fines or reputational damage, which directly hits the bottom line. This isn't just about growth. It's about sustainable, compliant growth.
Moving on to another impactful acquisition in the tech space, Duck Creek Technologies has acquired Send Technology Solutions. This is a strategic move to integrate an AI-native underwriting orchestration layer directly into Duck Creek's core insurance operations. Send Technology boasts impressive metrics, up to 7 times faster time to quote and up to a 65% reduction in product launch time. For group insurance carriers, this means unparalleled efficiency in risk selection, pricing accuracy, and rapid processing of applications across various group benefits. It's about accelerating speed to market for new products, enhancing broker satisfaction with faster turnaround, and ultimately delivering a superior employer experience through quicker access to coverage. This acquisition is a clear signal of AI's indispensable role in transforming foundational insurance processes.
AI native underwriting orchestration sounds impressive, Dorian, but underwriting is the absolute bedrock of carrier solvency. My immediate concern is the black box nature of some AI models. How does this acquisition address model interpretability, bias detection, and ultimately regulatory scrutiny from bodies like the NAIC, which are increasingly focused on AI model disclosure requirements? Faster quoting is desirable, but if it comes at the expense of pricing accuracy or increases the potential for adverse selection due to automated risk assessments, then we're trading short-term efficiency for long-term P&L instability. What's the data lineage feeding these AI models? Garbage in, garbage out, especially for IBNR calculations and reserving. A 65% reduction in product launch time sounds aggressive. Are we sacrificing thorough actuarial review, product testing, and critical compliance checks for speed? That's a direct threat to solvency and regulatory standing.
Aria, the term orchestration layer is key here. This isn't about replacing human actuaries or underwriters with an opaque AI. It's about augmenting their capabilities, providing decision support, flogging anomalies, and automating routine tasks. This frees up expert capacity for complex cases, significantly reducing human error and improving consistency. The speed allows for dynamic pricing models that can adapt to real-time market conditions, improving bind ratios and competitiveness. Reduced product launch time means carriers can respond faster to evolving employee benefit needs, bringing innovative solutions to market quicker, which drives market share and enhances the employer value proposition. It's about intelligent automation, not blind automation, ensuring a more competitive and responsive carrier ecosystem.
Intelligent automation still carries inherent model risk. How are the confidence intervals of the AI's risk assessments being rigorously integrated into the pricing models? What's the audit trail for regulatory review, especially when a DOI examiner inquires about a specific rate classification or denial driven by an AI output? The speed to quote must not compromise the integrity of the underlying actuarial assumptions or the proper assessment of aggregate risk. And regarding product launch time, while speed is attractive, the regulatory burden of filing new group products across 50 states with potentially 50 different sets of requirements means that a 65% reduction must be carefully balanced against the imperative for comprehensive legal and actuarial review. The P&L impact of a rejected filing or a non-compliant product is far more damaging than a slightly longer launch cycle.
Shifting gears to the distribution channel, Xywave has launched Xywave Apex, an AI growth platform specifically for insurance agencies and brokerages. This platform is engineered to deliver faster quoting, sharper account intelligence, and improved pipeline clarity for the front office. We're already seeing impressive early results. Customers using Xywave's producer agent component have reported email open rates 1.7 times the industry average and click-through rates 20 times the industry average. Integrating over 1,000 carrier connections and proprietary data, Xywave Apex empowers brokers to be significantly more efficient and effective in client acquisition and retention. This directly translates to better tailored benefit solutions for employers and a more streamlined experience for employees, ultimately driving market penetration and client satisfaction.
Broker efficiency is certainly valuable, Dorian, but from a carrier perspective, this raises a few red flags. Increased quote volume without a corresponding increase in bind ratio or quality could simply flood underwriting departments with noise, leading to resource strain and potential delays for legitimate submissions. Furthermore, the use of AI-driven client intelligence by brokers, what are the data privacy implications here? We're talking about potentially sensitive employer and employee data being processed by a third-party AI platform. GDPR, CCPA, and various state-level data privacy laws are paramount. If brokers are generating 20 times more clicks, is that qualified traffic leading to actual sales, or merely increased digital engagement that doesn't convert? There's also the potential for channel conflict if the AI optimizes away from certain carrier products based on its internal algorithms, impacting our market share strategies. Better prepared submissions is the absolute linchpin. We need rigorous validation that the AI isn't simply automating poor data input or generating quotes that don't meet our specific underwriting guidelines. The data integrity and interoperability between Xywave Apex and our carrier systems are paramount to prevent errors that could lead to mispricing or adverse selection. And let's not overlook the E&O implications for brokers relying heavily on AI-generated advice or insights for client recommendations. Who bears the risk if the AI's sharper intelligence leads to an inappropriate benefits package or an uncovered claim? From a P&L standpoint, any system that increases our exposure to inaccurate data or potential litigation must be approached with extreme caution and robust risk mitigation.
Let's pivot to product innovation. Mutual of Omaha's Workplace Solutions has announced significant enhancements to its employer-based accident insurance. The updated product now includes more than 40 new benefits, broadening coverage for accident-related injuries, including more inclusive sports coverage for all insured members, not just children, and clear, more inclusive policy language. This is a crucial move for market differentiation, enabling brokers to offer more flexible and comprehensive options. For employers, these expanded benefits demonstrate a clear commitment to employee well-being, providing more meaningful financial protection against unexpected accidents. This is a powerful tool for talent attraction and retention, directly impacting an employer's bottom line through reduced turnover and increased employee satisfaction.
40 new benefits, Dorian? My actuarial antennae are immediately on high alert. What is the precise actuarial impact on expected loss ratios? Have these numerous new benefits been properly priced and reserved, considering potential increases in claims frequency and severity? Broader coverage and more inclusive policy language often translate directly to expanded claim definitions and higher utilization, which can significantly impact the P&L. What's the aggregate benefit maximum across all these new components? Is there a risk of anti-selection if these expanded benefits disproportionately attract higher risk segments of the workforce? And the regulatory burden of filing these 40-plus new benefits across all applicable state departments of insurance is non-trivial, potentially delaying market entry and incurring significant compliance costs. They're designed to address evolving employee needs, particularly in an increasingly active and diverse workforce. The goal isn't just to add benefits, but to increase participation rates, reduce lapse rates, and strengthen employer-client relationships. By reducing coverage gaps and offering more comprehensive protection, Mutual of Omaha is enhancing the perceived value of the benefit, which translates to higher employee satisfaction and ultimately a better ROI for employers in terms of engagement and retention. This is about meeting the holistic needs of today's employees, not just expanding risk. While meeting employee needs is commendable, data-driven product development must be underpinned by robust experience studies and credible claim data for these specific new benefits. Have they modeled the claims frequency and severity for each of these 40-plus new components? What's the impact on the incurred but not reported (IBNR) reserve, particularly for benefits that might have a longer reporting tail? And how does this align with the overall portfolio strategy? Is this a loss leader to gain market share, or is it expected to be immediately profitable on a standalone basis? The regulatory scrutiny on new product filings is intense, and any misstep in pricing or language could lead to significant P&L adjustments or even market withdrawal. Solvency hinges on accurate pricing for every benefit offered.
Finally, let's look at a significant development in the retirement space with direct implications for group benefits. Voya Financial has expanded its Advisor-Managed Accounts program to allow registered investment advisors to allocate retirement plan participants' savings to private market assets. These new options include private equity, private credit, and private real estate, made available through newly launched Voya Investment Management's V-Alt collective investment trusts and Blue Owl Capital vehicles. With Voya serving over 18 million customer relationships, this is a monumental step in pushing alternative assets into mainstream 401k offerings. It's about democratizing access to sophisticated investment options, enhancing diversification, and ultimately improving participant outcomes, making retirement plans more competitive and attractive for employers.
Democratizing access to private market assets and 401ks also means democratizing a significant amount of fiduciary risk. My immediate concerns revolve around liquidity, valuation complexities, and higher fees. Private market assets are inherently illiquid, which poses a serious challenge for daily traded retirement plans where participants expect prompt access to their funds. How are these liquidity risks being managed and disclosed? Valuation of private equity or real estate is not a daily mark-to-market exercise, creating potential for significant discrepancies and participant confusion. ERISA 404A and 404C compliance, particularly around adequate due diligence and clear disclosure, is absolutely critical. The Department of Labor has been very clear on the heightened scrutiny required for alternative investments in qualified plans.
Aria, this isn't a free-for-all. The CIT structure mitigates some of the liquidity concerns, and these options are primarily targeted at more sophisticated participants or within managed accounts where professional advisors guide allocation. Voya's partnership with Blue Owl Capital, a leader in alternatives, brings institutional-grade expertise and rigorous due diligence to the table. This is about providing diversification benefits, especially for long-term investors, offering exposure to asset classes that have historically outperformed public markets over extended periods.
Sophisticated participants is a subjective definition, Dorian. The DOL's guidance emphasizes the need for thorough due diligence and clear, unambiguous disclosure understandable by all participants, not just the financially literate.
Voya's plans for comprehensive participant education to prevent unsophisticated investors from making inappropriate allocations to these illiquid, higher cost, and potentially more volatile assets. How are they managing potential conflicts of interest given the various entities involved? The potential for litigation and significant reputational damage if these private market allocations underperform or if liquidity issues arise is substantial. This directly impacts the carrier's P&L, solvency, and overall brand trust.
The fiduciary bar for these offerings is incredibly high, and any misstep could have cascading financial and regulatory consequences.
The opportunities for growth are undeniable, but the underlying risks to P&L, solvency, and regulatory compliance demand constant, rigorous analysis. Join us next time for more insights on the cutting edge of group benefits,
where we'll continue to dissect the data and challenge the assumptions.
For Aria the Actuary and myself, Dorian the Distribution Expert, thank you for tuning in.